All right. Welcome back to the Know Your Numbers REI podcast. This is your host, Chris McCormack, certified public accountant, MBA, certified tax planner with the American Institute of Certified Tax Planners. And it is my goal to help you, the taxpayer, the business owner, the real estate investor, eliminate the frustrations, the fears, the confusion, the concerns, the stress that you have around taxes by keeping more money in your accounts and less money in the government's account. And today we're going to be talking about one of the greatest strategies that can help you get there, and that is simply owning a business, right? We want to discuss what is known as, in some circles, the real wealth gap, right? When you consider the wealth gap, especially in today's society, I guess, in today's narrative, if you will, the wealth gap is always between the poor and the rich. And there is a problem, according to some people, with the rich having so much and the poor having so little. And yes, I fully believe that we should all of us that have been gifted much should go and help the poor in the ways that we determine to be the best way forward. However, there is this idea that the state, the government, must come in and take from the rich and give to the poor. And that is not something that we can get behind. But what we can get behind is educating you, the listener, the viewer, into what is actually the real wealth gap and why it might be such a large gap. And that is the gap between the business owner and the non-business owner, those who are out there producing versus those who are out there. Well, you're still producing as a non-business owner, but you're producing for somebody else's gain by and large. So if you get any sort of value out of this, please feel free to subscribe, like, review. And if there are any topics that you would like to see covered here on the Know Your Numbers REI podcast, please leave comments in the video section or the Spotify section. Spotify just instituted comments, and we will be reviewing those and seeing what you all think, and any topics that you guys want to talk about, we're happy to discuss. So the real wealth gap, the gap between business owners and W-2 earners. Why is it a gap? Is that fair that there's a gap? How can we close the gap? Or should we even be focusing on closing the gap? And I'm going to be getting into all of that. From a purely tax perspective, business owners get the lion's share of tax advantages, tax deductions, tax credits, largely because, as you know, if you've been following along on these podcasts, it is largely because the business owners, real estate investors, those who are producing economic results need incentives or desire incentives to continue to produce economic results. And there's a point at which you stop producing because it doesn't make any more sense, right? If you have a 37% tax bracket and the next tax bracket is 50%, then there's a cost benefit analysis that you have to do in order to determine, do I sell more? Do I produce more? Do I increase our revenues? Or should I just sit on my cash, invest it in savings accounts, stock markets, other areas where it's not going to be taxed at the same level, and go enjoy some mimosas on my yacht? So whether you realize it or not, that is a cost benefit analysis that all business owners have to do. Does it make sense to invest here where we pay more taxes, or should we invest here where we pay less taxes? So the wealth between business owners and W-2 earners, one of the big topics that we're going to discuss is the tax advantages. But we'll start off by saying that business owners have no cap of income. W-2 earners will never make more than the business, right? As a business owner, there is no cap. It is as much as you are provided. You can continue to go up. There are infinite amounts of numbers. And we see this in today, like the biggest business owners that you can think of: Elon Musk, Jeff Bezos, Bill Gates, Warren Buffett. There is no cap on their amount of income, their amount of wealth. Their employees, however, there is a cap, right? They're not going to pay them more than the business is making. They're not going to pay them more than they're making. They have a set salary, and it'll likely increase 3%, 5% every year, depending on the performance. And that's that. But if you are a business owner, you can see 100%, 1000%, 50% increases year over year from income that you have coming in. So there's a greater opportunity to grow, but there's also a limitless amount of money that you can bring in as a business owner compared to a W-2 earner, right? So that's right off the gate. If you're bringing in more money, you're going to be able to keep more money, invest more money, generate more money off of the money that you're making. And there is why wealth is more in the hands of business owners and investors than in the hands of W-2 earners. And again, also on that, when you're a W-2 earner, you're investing. If you're causing your money to make more money, chances are you're investing in the business owner's business, right? You have Tesla stock, you have Apple stock, you have Amazon stock, you have Shell gas stock. Like these are businesses that you're investing in, but there's an owner who has more of a share in that business. And so whatever you're making, they're making 10-fold, 100-fold, 300-fold on that money. And so there you have it. That's number one, why there is a wealth gap. And again, we can come back to the fairness. Is it fair that business owners have unlimited amount of income and W-2 earners are limited in their amount? Well, yes, because who's taking on the risk, right? There's a risk reward. The reason that there are W-2 earners is because they would prefer a set amount every year, a consistent salary that they can rely on and feed their family with. And I'm not saying that's a bad thing, but the business owners are like, there's no guarantee that we make money this year, but we're going to go out and try to do it anyways to see what happens and generate that money. And so from that perspective, from a surely business to W-2 earner income perspective, business owners have no cap. W-2 earners have a cap. Is it fair? Yes, because who's taking the risk? It's the business owners. The W-2 earners, I mean, there's risk involved, right? There's a risk of you losing your job, of you getting hurt on the job, of you not making the money because the business runs out of money, but it's not the same amount of risk that the business owners have. All right, so number two is the tax incentives. Business owners have tax incentives, W-2 earners do not. Now, when I say do not, I mean like generally speaking, right? Obviously, W-2 earners can get tax incentives in the form of retirement accounts, HSA accounts, child credit, all of these things, which again, they think about the why that is, right? The 401k is a retirement account that offers a tax benefit in the year that you contribute. The reason behind that is because, well, if you want to find out, there's a podcast episode that we did with Ten Bena, but it was in a time of economic instability. The government wanted people contributing and saving for the future, and the people wanted lower tax brackets. And so the idea was they can contribute to a 401k, defer taxes, and hope that tax brackets would come down, and then they could also invest that money. So the 401ks were set up to invest in companies. So then the business owners are like, if you can get more people putting money into these accounts and investing into our businesses, then we're going to go and use that money and produce economically and raise this up ourselves. And so what you see there is the W-2 earner gets an incentive, but at the end of the day, the business gets the benefit because they're putting more capital into their business. Yes, tax incentive for W-2 earner, tax incentive for generic Joe Smith, but the Apples, obviously this was in 1970s, so it'd be who were the Ford Motor Company and other businesses that were around at those times were getting still a benefit on the benefit that the W-2 earners were in the fact that they were getting the money that was being invested into these accounts. But other tax incentives. So the Internal Revenue Code is set up in a manner that the government wants you investing in certain areas. That's why real estate is great. The government wants you investing in properties so that their citizens have a place to live. They're going to give you tax benefits. As a real estate investor, which is a business in itself, so you're technically a business owner, you have a tax incentive to go and invest. If there wasn't that tax incentive, you might not want to put up with the struggle of tenants, the utilities, the changing interest rate, the property taxes that always seem to be increasing, right? Those are some headaches that scare people away. But to add something to give them a little reason to invest, the government's like, no, you can invest, you can get depreciation. We'll give you the opportunity to cost segregate. If you invest in these certain areas, you have the opportunity zones, right? These are all strategies that are available to the real estate investor. Other businesses, oil and gas. Right now, you're going to see as we enter a new season of presidents, and Donald Trump has he's laid his flag in the ground on the drill, baby drill area, oil and gas. And this was part of his tax cuts in 2017 too, right? It's an area that he wants people to invest in because he believes if we can have energy produced here in the States, we'll be able to grow into the powerhouse that we once were and want to continue to be. And so he offers benefits. He and his cabinet and Congress offer benefits to those who invest in oil and gas and those who produce oil and gas. Technology, right? We want to be at the front line of the technology sector. So there's benefits to being in the technology industry. I mean, even just owning a business, right? Because if you have new businesses being generated and people are able to receive tax benefits from that, but also receive the possibility of untapped wealth, well, then that's going to produce for the entire economy. So business owners have tax incentives for great reasons, right? Because without the businesses, there is no economy. Without the economy, you don't get paid. And so if you're a W-2 earner listening to this, whether you are on board with all of the tax incentives that businesses get, or you're not on board with the tax incentives that businesses get, understand that without the businesses, there is no job, right? There is no W-2. It's a business who employs you. And so there's tax benefits for employing people, right? But all of this creates more wealth, right? The real wealth gap is between business owners and W-2 earners. It's not between the rich and the poor. It's between those who own businesses and those who don't. And tax benefits are one of those, right? If you have a great amount of tax benefits and you're able to keep more money in your accounts and then invest that money into the economy or into your business or somebody else's business, you're going to grow and prosper at a level that is much greater than that who doesn't get any tax benefits and has to invest in your businesses, right? So number two is the tax incentives. Number three, business owners can exclude gains on the sale of the business. There's a lot to consider when it comes to this, right? But there is a part of the tax code, QSB is what I will call it, but it basically Section 1202 basically says that if you're a C corporation, you've been there for 5 years, we're going to let you exclude a certain amount up to millions of dollars in gains on the sale of your business when you go to sell. W-2 earners have to pay taxes on the money that they earn. Any money they invest in a stock portfolio, they have to pay taxes on the capital gains, right? So if you own a business, you own a large portion of the shares in that business. If it's set up properly, you can avoid taxes on the sale of the business 20, 30, 50 years from now. If you don't own a business, you're getting taxed on the paycheck, and then the money that you're investing from that paycheck after taxes is going to be increase in value, and you're going to pay taxes on the gain. So for a business owner, you can avoid taxes on the sale of your business. Taxpayers, W-2 earners cannot avoid taxes on the sale of their shares of the business, right? So there's another reason, okay? If taxes are going to be tapping into a large amount of wealth, then you're able to avoid taxes that other people have to pay, you're going to have more wealth, right? So that the wealth gap is between business owner and W-2 earner. It's not between rich and poor. Now, business owners tend to be the rich, and you could say that W-2 earners tend to be the poor. I know plenty of W-2 earners that have made a great living for themselves getting a W-2, but it's not to the level that the business owners have, and the tax incentives and the avoidance of capital gains and the untapped income levels makes it all possible. Another reason that business owners are able to amass a large amount of wealth, whereas taxpayers, W-2 earners, are not, is because of the qualified business income deduction. Business owners automatically, if they're classified as the right business, again, these next two are specific to certain businesses. A lot of businesses get them if you're working with a tax strategist. If you're worried you're not getting them, get on our calendar and let's talk. But if you are a business owner, you automatically get a 20% deduction without spending a dollar, right? So qualified business income, the QBI deduction, is part of the 2017 Tax Cuts and Jobs Act. Come 2025, it's going away, but Lord willing, Donald Trump will enact it for the rest of the United States lifetime. So the 20% QBI deduction is income up to a certain point, call it 360,000, it might be up towards 400,000, is you can automatically deduct 20% without spending a dollar, 20%. So if you make $100,000, you qualify for the QBI deduction, 20% of that $100,000 is written off, you don't spend a dime, and now what was $100,000 is $80,000, you pay taxes on the $80,000. That's $5,000 of taxes saved, right? Just quick math, 20,000, say 25% tax bracket, it's 24, and you get $5,000 of tax saved. Now, project this out on a massive scale, right? If you're making $300,000 and you get a 20% deduction, you write off $60,000. That is $15,000 of taxes saved every year. And now you're starting to develop a large nest egg. You're able to reinvest in your business, somebody else's business, the real estate, wherever you are making moves to generate wealth. Whereas a W-2 earner has to pay taxes on all the income, right? Minus income that they might write off from retirement accounts or say HSA accounts or because they have a child. None of those are gonna even come close to 20% of your income. So a W-2 earner has to pay taxes on all the income. QBI qualified businesses pay taxes on 80% of their income. All right, so we've talked about the no cap on income. We've talked about tax incentives. The last two have also been a form of tax incentive, not paying taxes on the sale of your business, not paying taxes on 20% of your income if you qualify. This next one is also a tax incentive. So we're unpacking the tax incentives that you qualify for a little bit, but business owners are able to write off many expenses W-2 earners cannot. Now this changed too. Typically, if you worked from home as a W-2 earner, there was a time where you could write off some of the expenses related to your home office. Now it's only available if you own a business. So that's just one expense that you might qualify for as a business owner that you don't get as a W-2 earner. Meals and entertainment, another expense, right? If you have meals with business partners or people that you're networking with or clients or tenants or whoever it is, you get to write that off as a business owner. If you don't own a business, you can't write off a single meal, okay? Mileage, interest. These are expenses that some people are incurring on a regular basis, right? Interest meaning home office interest. You can write off a portion of your mortgage interest if you own a business. If you don't own a business, you can't write off any part of the mortgage interest. Minus itemized deductions, but then you get into the conversation, okay, itemized deductions typically aren't as great as standard deductions unless you have large amount of charitable expenses or large amount of medical expenses. So again, business owners, an expense that isn't written off as a W-2 earner can be written off as a business owner. So meals and entertainment, some housing expenses, travel expenses. If you're going to travel for business, whether it's to conferences or to meet with clients or to meet with business partners, that can be deductible. Oftentimes people who are in W-2 jobs are paying to travel to friends and family or with friends and family. If they had a business they might be doing business with. And so there's another business expense that business owners qualify for, a tax write-off that business owners qualify for, but W-2 earners do not qualify for. This one's a fun one. I liked when this one came up. Business owners get rewards points on credit cards and tax deductions, right? So credit cards are the big thing these days. If you ask Dave Ramsey, it's bananas. actually, to me, it can be kind of bananas. I recently found out that the credit card processors, so if you own a business, you know that credit card processors take like 3% of the income that you're running through the credit card processor, whether it's Stripe or some other payment processor. They're taking a large amount, 3%, which amounts to a large dollar amount if you're making $300, $500, $1 million a year. That 3% is what they collect and use to pay off the credit card's rewards points, right? So if you collect credit cards rewards, say you get 1%, 2%, 3% cash back. Well, look, somebody just made $1,000, they pay 3%. Somebody just spent $1,000, we're gonna pay them 2%. Now we just made 1% on money that wasn't ours to begin with, right? So I say this, the things that we think are free are not free. There's no such thing as a free lunch, right? So credit cards, rewards points, your business is paying for those, right? And I mean, if you want to get around these things, we do have a referral partner. They have a payment processing company and they eliminate or limit the amount of processing fees that you are taking on. And then any money that they do raise, they're giving to charities of your choices. So if that's something you're interested in, you want to decrease the amount of processing fees that you're dealing with, reach out to me. I can put you in touch with our referral partner. But the point is, business owners are using credit cards and W-2 earners are using credit cards. The difference is business owners get a tax write-off for their credit cards and they get the rewards points. W-2 earners only get the rewards points. They're spending money and no tax write-off, right? Then there's the retirement account options, right? We talked a little bit about 401k options. If you are interested in doing a tax plan and talking about the way that retirement plans fit into that, I would love to have a conversation with you. It goes far deeper than anything I can cover here in this podcast, but W-2 earners will have the option of IRA or 401k. Not only do they have those two options and they're limited to those two options, but an IRA under current law, $7,000 contribution limit won't get you very far. And then a 401k is a little better. It's $23,000 as far as I know. They might have increased those for 2025, but that between the two, that's $30,000 worth of contributions. A business owner under the right entity structure can open up what is known as a solo 401k, and they can contribute up to $69,000. Don't quote me on those numbers, but it's over $60,000 of contributions can be made to this retirement plan, which again, if you're only allowed to contribute $30,000 or just say $60,000, one is half of the other, also known as one is 2 times the amount of the other. Who's going to amass a greater wealth? Probably the one who can contribute 2 times the amount, get a tax deduction for all of that, and continue to go for untapped income levels, get tax write-offs that the other person does not have, right? So this is the real wealth gap, my friends. And the reason I'm bringing this to you is because, well, we just overcame a pretty heated election season, and a lot of the topic of conversation was like, okay, you're only going to create tax incentives for your rich friends that are down in Mar-a-Lago versus we need to tax the rich and give to the poor because the wealth gap is unfair. And then when you look at it, when you peel back curtain a little bit, you understand that the real wealth gap is between those who are willing to take the risk through business ownership and those who, whether for better or for worse, are happy with a consistent and relatively risk-free income level in their mind. Again, it's not risk-free. You have the risk of losing your job. You have the risk of getting your pay cut or not getting a raise, depending on the performance of the business, right? Whereas if you own a business, a lot of the performance lies on your hands, and it's not an easy burden to carry. I won't be the first to tell you that, but it is worthwhile. You have more opportunity, more tax write-offs, more ability to create and produce and conserve and preserve wealth. And so that's why there is this large wealth gap between business owners and W-2 earners. And whether you like it or not, it's how things are set up. And I think I would argue passionately that this is a good thing, that business owners should have the greater amount of incentives and ability to build wealth, because otherwise, again, if you don't have that, there is no economy and no jobs, and we're all left to fend for ourselves or relying on the government to provide for our needs, and that's not where we want to be. So let me know what you think. Again, if there's any topics that you want to talk about, go ahead and comment below, subscribe, like, leave us a review, and if you think there's somebody out there that could get value out of this, please do us a favor and share it with them. We love you, God bless you, and keep moving forward.